Welcome to this lecture on 3701. Today we are calculating the tax liability of a company, and we are doing question number 3 of the June exam paper for this year. Let's look at the question. The question asks us to calculate the normal tax liability of Morofeng Pty Limited. This question has got 30 marks. So let's do this question together. And let's read the question. This question says Morofeng Pty Limited is a manufacturer of solar products. The company's manufacturing activity have been approved for SARS as a qualifying process of manufacture. The company is not a small business corporation as defined in Section 12E of the Income Tax Act, and its financial year ends on 31 March 2024. MF is a registered VAT vendor making only taxable supplies. Where necessary, MF obtained valid tax invoices and the required documentation for all the transactions. All amounts excludes VAT where applicable, unless specifically stated otherwise. So let's look at the information provided. So we have our sales. So when we calculate taxable income, the sales is actually income. So we have to add the sales. And our sales here is 2998 527, and there is no note to show that there is any adjustment, so we will put the figure as it is. And from there we'll look at the next line is dividends received. This line on dividends received, it does have a note number 1, so we'll have to go and read note number 1 so that we can make adjustment to dividends received. Let's look at note number 1. Dividends received. MF received a local dividends of 45,350 in respect of a 30% shareholding, which the company has in Lubelo, a South African incorporated company. So now these dividends are from a South African company, and MF also received foreign dividends from a company which is effectively managed in Sweden, where MF owns 14% of the equity shares but holds no voting rights in the foreign company. So let's start with the local dividends. What we know is that local dividends are exempt from tax because they come as net dividends. Local dividend amount 45,350. Local dividends 45,350. Then exempt. Then we go to foreign dividends. Foreign dividends. On the foreign dividends, we have 13,500. And we have noticed that they don't hold the voting rights to the company, although they own more than 10%, which means that these dividends were supposed to be exempt, but because they don't having voting rights, we are going to tax partly some of the dividends. Less exemption. Let's calculate the exemption. Then from dividends we have prize won. Prize won. Hmm? Muri kurekodwa muchitaura zvesadza, please. Muri kundikanganisa, please.